burn rate, and this is really important for the startup world. And if you're investing, you need to know what this means.
Yeah, you do. It's a real classic phrase, of course, but it's misused a little bit, and sometimes people don't really understand all the subtleties of why it can be important. So, first of all, a couple of usage tips on burn rate. It is, of course, the amount of money that a startup is losing. You usually mean per month. So if you just say, what's the burn rate, you mean what's the monthly amount that you're losing. And it's important to distinguish it from the expense rate, because burn rate does take into account revenues. It's a question of how rapidly the startup is burning through the cash in the bank.
So basically, how long this new entity can go without begging for more money from somewhere else.
Right, exactly. And of course, that has lots of implications. Some of them are obvious. You don't want to be investing in something that's just about to hit the wall. But one of the reasons that it's important to make sure that the company does have some runway is because you don't want the management team constantly in fundraising mode. If they're, these are by definition, right, these are by definition very small management teams, right? They can only do so many things in a day. And if they're running around the streets trying to raise capital all of the time, it's very unlikely that they're also executing well on their business plan.
What else does a prospective investor need to know about this term when he or she is evaluating a new opportunity?
So one of the things that I like about focusing on the burn rate is that it puts the spotlight on what is the revenue model. What is the revenue model?
It's very East Coast of you, Bob, right?
I know, it is very East Coast, and it's almost a religious divide between the East Coast and the West Coast about whether we pay attention to such things. The question is, let's say you think you've just looked at the next YouTube, which, by the way, still isn't really making any money. Are you going to invest in that thing? Now, from my point of view, if you're not a professional VC and you have tons and tons of dry powder that you can continue to drive something like that, you're not at least a professional angel investor, I would say I would stay away.
Yeah.
I would stay away from things that don't have some sort of evidence of a revenue model.
Okay, so that's pretty clear. But what if the company is actually generating revenues? It's just that they also have high costs. What do you do then?
Well, I think that if they're generating revenues, that's a great sign, and it's really important to focus on that for a moment. They don't really have to be generating huge revenues. That first check is the hardest thing in the world to do, and it's the ultimate proof of concept that the entrepreneur, the startup, is onto something. In fact, I was at breakfast just yesterday, I think, with one of the more famous entrepreneurs out there in the world, and he was joking to me how much easier it is to get investor checks than customer checks.
Ah, okay.
So if you've got a startup that's got some proof of concept, that's actually a pretty good time to invest, because then your dollars are being used to scale something that's already working a little bit. If you don't, the flip side of it is that if you've just got a plan and nobody has ever actually bought into this at all, then it's a lot riskier.
All right, so very early growth capital. How do you figure out where you are in the timeline and then how important this metric is?
Right, so that is the idea. Very early growth capital. So you're scaling something, again, that already has shown that it's got a little tiny bit of traction in the market. And these days, by the way, that's much easier to demand than it was 10 years ago when it took a huge amount of capital to get anything going. Now, as you know, it takes a very little amount of capital to get something actually into market, and so you can see a proof of concept. It's much more reasonable to demand that you see that before you put any money to work now. And one of the key reasons, coming back to our term burn rate, that's important is, even if, as you were saying, expenses are too high and the company's going to have to go back to market, if it has a proven revenue model, the chances of it actually raising that capital are much, much greater. That puts you in a much better position as an early investor.